Good afternoon or good morning, depending on which side of the country you're on. I'm Charlie McQueen, President of McQueen Financial Advisors. I'd like to welcome you to our continuing 101 series. Today we're really excited for Investments 101, and we've got a great group. So thank you very much for joining us today. Next slide, please. So I'm Charlie McQueen, President of McQueen Financial Advisors. And I'm really excited to have two representatives with me today of our investment advisory team, which we'll talk about, both Alicia Bradley and Kelsey Mulholland. The two of them are part of our investment team. We also have our interest rate risk management team. We're great to have them there. And then our other team, or our third group, is our valuations team. So today I have our two co-presenters here. Alicia is one of our investment advisors who's been working with us for a long time. She's a great background on the financial analysis and bond buying activity. Really excited to have Alicia here with her expertise. Along with Kelsey. Kelsey is also a senior investment advisor with us in our investment team. Kelsey has a great background, actually started off working in credit with us and has grown and become one of our credible portfolio managers also. So thank you, both Kelsey and Alicia, for joining us today. Thank you. So today, a little housework here. If you have any questions, please feel free to submit them. If you move your mouse around the screen, you'll see an area pop up sometimes in the bottom of the screen with Q&A. Go ahead and pop in and put your question in there. We will answer your question throughout the webinar, or we'll do it at the end, whatever is appropriate for the question. So please feel free to add your questions at any time. Also, today's webinar will be recorded on our YouTube channel. If you'd like a copy of it, please reach out to your MFA advisor, and your advisor will get you a copy of that. So with that, I'm really excited. Our 101 series here has been having lots of positive reviews from a lot of our friends out in the world, and we really appreciate all the comments and feedback we get after these presentations, so please feel free to reach out to me with those. And with that, to kick off the agenda today, we have Kelsey here to talk and go through the agenda.
That's right. Thank you, Charlie, for the introduction. Again, welcome everyone to the webinar, Investments 101. So our goal for today is to cover some of the basics and some of the behind the scenes type topics when it comes to investments. These are the topics that we're going to cover, including policy, portfolio strategy, asset classes, trading, and documentation. Like Charlie said, we have the Q&A open, so please feel free to submit your questions throughout the presentation. The chat is open as well, so pop in there and say hi, let us know you're here. To get us started though, I will throw it back to Alicia, and we are going to start on the policy section.
All right, well, welcome. Thank you so much, everybody, for coming. One of the most important parts about investments is your investment policy. Investment policies are traditionally written by management, and then they are approved by the board, and they're reviewed on an annual basis. That review really comes into play on an annual basis, even if there are no changes to the policy, just to make sure the board knows everything that is in there that the credit union and or bank can take a look at and purchase. We don't want any surprises mid-year if we decided to start purchasing an asset class that we previously hadn't been purchasing if the board hasn't reapproved the policy that year. So some of the basic portions of your investment policy. The first section is typically your purpose and or objective, stating the why behind why we have an investment policy. What are we going to do with those excess funds, and how are we going to do it? There is a corporate governance section that dictates who at the financial institution is allowed to approve investments and what the responsibilities of both the ALCO and the board are, i.e. reviewing the policy on an annual basis, one of the big ones. There is typically a section that authorizes the institution to delegate the authority to a third party. Typically, it is an SEC registered investment advisory firm, such as your great team here at McQueen Financial. And it also decides who has discretionary or non-discretionary authority. Most of the time, the clients still have the authority to approve all of the investments. On the rare occasion, they will delegate that authority to the investment advisor. Pretty standard list of your authorized and or unauthorized asset classes, as well as the limits for each one of those asset classes, whether it be a percentage of portfolio, a percentage of equity, your term limits, average life, all of those things are laid out in your policy. There's also several sections regarding your broker-dealers. You're going to have an approved broker-dealer list or approved broker-dealer section. If it's a list, it may only be a couple of basis points simply listed there in the policy. If it's a very long list, like we have here at McQueen, you may have it added as an addendum to your policy where all of those brokers are specifically listed out. Then you'll also have a broker-dealer selection and approval policy. That broker-dealer selection and approval policy goes through what you do on an annual basis to review the broker-dealers and the respective firms that are on that list, as well as how you go about approving them. We at McQueen have an annual due diligence for all of the broker-dealers on our approved list. All of those documents are then also relayed to the clients on our McQueen Secure portal, and that the clients are also responsible for at least reviewing those on an annual basis to make sure that they're doing their appropriate due diligence as well. And then there's also a good section on pre-purchase analysis so that you as a client know what you're actually buying. Some policies are extremely specific and they actually detail the individual Bloomberg print screens required. Others are a little more broad and generic, simply stating that you take a look at a couple of specific things depending on the complexity of each asset class. And then from there, Kelsey is going to talk to us about the different kind of risks we carry in our portfolio and how we include those in our policy.
Yes, thank you. So risks, this is another really important section for your investment policy. It needs to include essentially a definition of risks. The purpose of this section actually isn't to outline prohibited investments or activities, but it's actually just to make the risks known so that they can be managed and understood within the portfolio. And managing these risks overall really involves keeping a diversified portfolio and making your investments in accordance with your policy limits. So we have a couple of bullet points here of the examples of risks that you might include: interest rate risk and liquidity risk, concentration and call risk, prepayment and extension risk, and then credit risk is on here as well. So to give a couple examples, if we look at call risk, some ways to manage this would be to ensure that the portion of callable securities in your portfolio is kept to a reasonable level and that call structures on those securities have limited optionality. Credit risk is another example we can talk about. This would be something that a municipal bond or a corporate bond has exposure to. But credit risk can be managed by completing a good due diligence on the issuing bond at pre-purchase to start, but then also on an ongoing basis to cover the financials and any changes there that might happen in the credit profile. But in reality, most of these risks are going to be managed to some degree just by having a well-diversified portfolio. And we'll refer back to a couple of these a little later on as we talk about the specific asset classes that an investment portfolio can have. Next slide, please. To continue on with our policy, here's a couple more sections that are important to include in your investment policy. So the first on this slide, procedures for holdings that fall out of policy. Essentially, regulation wants the process for holdings that fall out of policy to be laid out pretty clearly. For example, if you owned a municipal bond that was downgraded to a rating that was suddenly lower than your policy's minimum rating, what you need to do is know the steps involved in rectifying this situation. So for example, are you going to notify the board, make a decision on whether to keep or sell the security, and include whatever decision and the talks about this investment in your meeting minutes so that everything is well documented? Because just because something is within policy limits at purchase doesn't mean it's going to stay that way. So that's why this section is important. The next bullet point for conflicts of interest. So what this is primarily going to refer to is accepting gifts from a broker-dealer. This is because a broker does receive commissions on trades. So accepting a gift from a party like that you conduct trades with is a direct conflict of interest. And that's something that we definitely want to avoid. Safekeeping, this is something that also must be board approved. Your safekeeper should be approved by the board, and you should also have a custodial agreement written up for that as well. Your approved safekeepers will be listed in your policy and updated and reviewed annually, similar to the broker-dealer list that Alicia mentioned. And then we have the classification of securities. So 3 types here that you might be familiar with: HTM, AFS, and trading. Trading is actually a prohibited activity under most policies, so this classification is not one that should be used typically. What trading is referring to is a short-term buying and selling of a security with the goal to make a profit on the sale. That's considered more speculative activity, so it's not something that an institution's investment portfolio should be doing in. So these other 2 classifications, AFS and HTM, these are probably more familiar to some of you. You might recognize them from parts of your call report. But let's start with the HTM. So this stands for held to maturity. Under this classification, bonds that have this classification don't report an unrealized gain or loss position. They're reported at book value. So the disadvantage here is that if you needed to sell a security that has the HTM classification, you could end up having to completely reclassify the rest of your HTM holdings to the AFS classification. And all at once, that could be quite a big headache, because that's going to involve bringing in the current market values on those securities and pulling in that unrealized gain or loss all at once, versus something that had been AFS at purchase. It's a little bit easier to manage. So with this HTM classification, though, there are some exceptions to when you might need to sell it. For example, if something is within 6 months of its maturity date, at that point, it's okay to break this HTM classification and sell the bond if necessary. Also, if the bond in question has some increased credit risk, there's been a downgrade in the credit profile, and there's some concerns from that perspective, at that point, you would be allowed to sell the security as well, because it becomes more of an issue of maintaining principal versus maintaining the classification. The AFS classification, so this stands for available for sale. This is the other alternative here. In this instance, securities do have the associated unrealized gain or loss position that's updated monthly. The benefit here, of course, is that if you had a security that you wanted to sell, this can happen without any adjustments on the rest of the portfolio, the other classifications. So you don't need any special circumstances to sell this type of security.
Kelsey, can you have both available for sale and HTM securities in your portfolio, or do you have to decide that at the time a portfolio is established?
Yeah, that's a good question. So you can have both at the same time in your portfolio. You're essentially deciding at purchase of each bond how you want to classify that as HTM or AFS. So your portfolio can contain both types. It's just kind of difficult to switch once that's been established. Good
Awesome.
question, though.
Thanks.
So next up is the portfolio strategy section. So you've made it through the policy work. Stick with us. It's just going to get more exciting from here. Alicia, why don't you start us off?
All right. So one of the big questions is always, why do we have an investment portfolio? As one of my favorite clients has recently put it, because we're sitting on a lot of COVID cash and we can't lend it. I love her use of the term COVID cash. We're all sitting on a significant amount of excess cash right now. For some of us, lending has increased. For some of us, it has not. So what are we going to do with that excess cash? Well, for most of us, it's going to go in our investment portfolio. Well, how do we determine that portfolio strategy while putting all of that excess cash in there? Part of that strategy is determined by what do you actually use your investment portfolio for. Some institutions use their portfolio as a source of cash flow for lending, meaning that the constant outflow of cash flow from either static maturity securities or amortizing securities is used to help fund their loan growth on an annual or monthly basis. Other institutions use the cash flow from their portfolio to help fund a deposit outflow. Some institutions have a very cyclical outflow of deposits, so we build up an investment portfolio in specific months and every year to help fund the outflow of those deposits in those given months. For other institutions, their portfolio is nothing other than an excess liquidity tool. They use it as a minimum percentage of assets. It's not a requirement that the portfolio stays at X percentage of assets, but they often have a goal. And for those clients, they don't put excess cash in the portfolio unless absolutely necessary. They keep the portfolio at a certain dollar amount. It tends to fluctuate year over year. And as things roll out of the portfolio or that percentage of assets from a dollar total starts to decrease, they will then put investments back into the portfolio. And those are the best 3 ways to work on starting to build your investment portfolio strategy, is by knowing what you actually use your portfolio for. When putting that strategy to work, we do have some basic principles that we have to follow: safety, liquidity, and yield. And Kelsey is going to talk to us about a couple of these.
Yes, so these are the principles that we should work with, like Alicia said. Safety, liquidity, and yield. And actually the order that we put these in is important, because this is the order in which they should be considered. The primary goal of the portfolio should be safety of principal. The investment portfolio is not the place for institutions to take big risks in credits or high premiums on bonds. So all your investments should be chosen first and foremost with safety in mind. The second principle that we get to is liquidity. So like Alicia mentioned, the investment portfolio is often a source of additional liquidity for institutions. Beyond having that AFS, or available for sale, classification on your bonds, you can also manage the overall cash flows to help with liquidity needs. Having a standard maturity ladder that has a nice curve to it, that's the picture on the top right. This is what we most often see in our institution's maturity ladders. Nice standard cash flows year to year that kind of taper off in years 5 and 6. And as we invest each year, we just keep this nice curve in shape. But this doesn't have to be the shape of every maturity ladder. There are other options. For example, there's the barbell option. That's the picture on the bottom right. In this scenario, we would have a higher cash flow in the short-term years and the longer term, and less cash flows coming due in the medium term, essentially. So it really depends on each institution and what your liquidity and cash flow needs are. And that's what you want to use to determine what your maturity ladder looks like. Alicia, which one do you like better?
I like the one on the top better. It's a lot easier to manage than the barbell ladder.
That's true.
And then the last.
Let me hold on before you move on 1 second, Alicia and Kelsey. I was asked a quick question here. So someone out there reached out and said, so are you saying it is best to not put the excess cash to work, COVID cash into work for an investment portfolio, or are you saying that we should invest the excess COVID cash into the investment portfolio?
You should be investing the excess COVID cash into the portfolio unless you have an extremely heavy loan pipeline and you are able to put that cash to work on loans.
And I'll probably add in there, the loan officers always think they have a good loan profile or pipeline coming, excuse me. But yeah, it's really interesting. Such low yields today in cash that it really makes sense to invest those dollars. So I wanted to make sure that we got that message out there.
Yes, always put it to work. And that plays into actually our third principle here is yield. Like Kelsey stated, the portfolio is not the place to take risks. And the majority of the investments that we're looking at right now do have a very low risk. Your options right now, if you are not lending, are to leave your funds in cash anywhere between 5 and 10 basis points, depending on where you safekeep or where your excess cash is held and how much you have, or to put those investments into a fixed rate maturity. We know that we end up with a little bit of extension depending on how far we go out, whether we keep it short term or long term, but you're able to put that cash to work, and we don't get to often say this, in something yielding 4 or 5 times what you're earning on your overnight cash. And then also the optionality of any bonds that we're looking at do come into play with that yield. So knowing the type of bond that we're buying also plays into one of those principles. And then from there, we will get into asset class diversification. A couple of things here. Most importantly, why is asset class diversification important? We have 3 different things here. The first one being yield. Right now, market's a little bit topsy-turvy, and Charlie's going to hate me for saying this, but we can buy Treasury bonds at a better yield than we can most bullet agencies. really sorry, Charlie, it's not our fault. It is the market's fault. So typically, though, you would get a much lower yield on a Treasury bond than you would on an agency bullet. Sometimes it's 5 basis points, sometimes it's 15 basis points. But when we look at a Treasury agent or a Treasury bond compared to a municipal bond or a corporate bond, there's typically a much larger difference in yield there. So being able to pick up a higher yield for the same term is helpful to the bottom line when we're talking about our interest income at the end of the day. But then if we're talking about that same Treasury bond and that same corporate bond, you have to know your risk profile and where you're comfortable. Every institution is different comfortably with what type of municipal and or corporate bonds they're willing to purchase, not only from a ratings perspective, but from a McQueen ratings perspective, whether it is a short-term bond or a long-term bond, but all of those things play into that yield and offer something different for the portfolio. And then also we have our weighted average life. Some bonds have a static maturity, i.e. our Treasury bonds that we were just talking about. Some bonds have an amortizing cash flow, like a mortgage-backed security. With the mortgage-backed security, you get a principal and interest payment on a monthly basis, as where with a static maturity bond, you get all of your principal back in one lump sum with typically semi-annual interest payments. So the cash flow is just a little different there. And then from there, we have a few different types of asset classes. I have some of the really boring ones, our basic Treasury and agency bonds. Kelsey's going to get into the fun ones here on the next slide. So we have Treasury bills and notes, Treasury bill being 12 months and in, Treasury note being anything longer than 12 months. Easy debt to buy. There is a maturity or two in any given month that we can pick up, typically the lowest yielding investment because it is the safest investment. From there, we have agency paper. We have agency bullets that have a static maturity. We have agency callable bonds, which have a final stated maturity, but have some optionality in them. Sometimes they are callable in 3 months. Sometimes they are callable in 1 year. And then there's the call frequency. Sometimes they're continuously callable, giving us a higher yield than things that may only be callable annually. And then we also have step bonds as well. And with a step bond, they have a final stated maturity. They are typically callable at their step date, and on that step date, the interest rate will change from interest rate A to interest rate B until the maturity. They're typically called away prior to their maturity, though. Then we have mortgage-backed securities and CMOs, which are collateralized mortgage obligations. The majority, I shouldn't say the majority, almost everything we buy is government-backed. I don't think we've purchased a private label in many, many years. There are a few portfolios that have them. However, they are not things that we've purchased. We tend to stick with the GSE-backed MBS bonds. There are private label MBS bonds out there. There is credit work that is required to go into them. And a lot of people are really uncomfortable with them, given the housing crisis we had several years back. And then we have CMBS. CMBS bonds are commercial mortgage-backed securities. The most common types are Fannie Mae DUS bonds, which is a single loan wrapped up into one security, and Freddie K bonds, which are issued by Freddie Mac, and it is multiple loans wrapped up into a pool, similar to a mortgage-backed security, except that all of the properties are multi-unit housing projects. And then I'm going to let Kelsey take it away with some of the credit-related asset classes.
Sounds good. One thing I would add with the mortgage section that you went through on the previous slide, Alicia, is that those are the types of bonds that have the prepayment and extension risks, one of those risks that we talked about up top. Yeah. So another thing to consider in the overall risk profile in that type of security. So on this page, here's a couple more asset classes. CDs at the top. This is tends to be the asset class that most institutions are most comfortable and most familiar with when they first start investing. This stands for certificates of deposit, but that familiarity comes with just being on the issuing side of a CD. And so typical like beginner investment portfolios are going to be pretty heavy in CDs is one thing we've noticed. The benefit to these, one of the pros is that they do carry that FDIC or NCOA insurance up to the first $250,000 of your holding. So that adds, removes the credit risk that otherwise would be involved in holding funds from that institution. The next bullet point here is corporate bonds and bank notes. So these are marketable securities that are issued by U.S. chartered corporations. This is one of the asset classes that does come with credit risk. So this must be reviewed at purchase before you decide to make the purchase, and then also monitored on an ongoing basis to stay within compliance. Banknotes are a special designation type of corporate bond that federally chartered credit unions are allowed to invest in. So some FCUs have been taking advantage of this kind of subset of the corporate asset class to pick up some extra yield as well. Municipal bonds, these are debt securities issued by US state and local governments. So an example would be the city of Clawson or the state of New York. Like corporate bonds, the municipal bonds are subject to credit risk and they need that ongoing monitoring of the credit profile. In addition to the credit risk, the municipal bonds also have this nuance of different tax statuses that they can issue. They can either be taxable or tax exempt, and the tax exempt category has another subcategory of bank qualified. So let's go through these really quick, and I have an example just to see the yield comparison as well. But a taxable issuance, this means that the interest income earned on a taxable security is subject to state and federal tax. And to compensate for that, the yield on a taxable bond is going to be a little bit higher. And that's what we can see in this table off to the left. The taxable yield, the top line at 1.19%, compared to those other tax exempt yields, more than double the yield in this case on the 5-year part of the curve. So definitely better compensation there. And a taxable bond is especially beneficial to a credit union as well. The tax exempt category, this actually makes up the bulk of the muni market, even though it's not a space that most institutions play in because it doesn't make sense typically from a yield perspective. You can see the tax exempt yield at 0.54 here in the 5-year space. To give some context, the Treasury right now is probably, 0.84? Yeah. So the negative spread to Treasury on a tax exempt muni bond is not looking great. But we do have the bank qualified type of issuance. This is a special tax advantage that banks get on this designation. So a little bit of a pickup in the taxable equivalent. I have that off to the side at 0.69. You'll see it is still lower than the 5-year Treasury actually, but the relative value of bank qualified and taxable bonds does shift over time. Several years ago, when the market looked different, a bank qualified municipal bond did actually have some nice relative value over other options of a similar term. So that can change. But right now where the market is sitting, the taxable space is really where the value is.
Kelsey, you mentioned that the value shifts from time to time on taxable bonds versus BQ bonds. And I think that holds true for all asset classes. I know right now there is a significant, I shouldn't say significant, but there's more value in the MBS space than there is in the CMO space. And I remember several years back, there was no value in the MBS space and we had to look for strongly structured CMOs in order to pick up that additional yield if we needed an amortizing product. So that value does shift from space to space. So making sure that you have that diversification within your portfolio allows you to pick up the best yield for the term when it comes time to put cash to work.
Yeah, that's a good point. And we see this time and time again. You know, CDs is another example that right now there's very little value in buying a CD because institutions just don't need the cash, so the rates aren't there. But 2 or 3 years ago, CDs were one of the best asset classes we could buy for our clients.
Absolutely.
So it does change, and that kind of pulls back the importance of having a really robust policy as well. If we have covered the available asset classes approved in the policy, then depending on what the market does, how the yield curve shifts, we know we'll be able to take advantage of whatever asset class has the most relative value at any given time.
You got it.
Hey, just let me interrupt for 1 second. Just a quick question. Someone asked the question, are we talking about Freddie multi-unit bonds or CMOs? And I was guessing in relative, we talked a little about CMOs and pass-throughs. Were any discussion about Freddie multi-unit bonds at all?
We did. Those will fall into, and let me see if I can skip backwards. Nope, I can't skip backwards. Those will fall into the CMBS space. Freddie Mac has a couple of different collateralized mortgage programs. They have the Freddie K program, which will be multi-unit, typically like your apartment buildings. And then there are also FRESB loans as well, which are smaller business loans, typically on multi-unit housing projects. Those come on a once-a-month basis versus the Freddie Ks that come every couple of weeks or so with various different structures.
Okay.
And they are, I should note that the Freddie K or the Freddie bonds, whether it be a CMBS or whether it be a Freddie K or a FRESB, they are considered CMOs because there are different tranches within each different term.
Cool. Thank you very much. And just a note to all the viewers out there, I am getting your questions. Some of them we're going to answer at the end. So if I haven't answered your question yet, don't worry, we'll get to it. Another question did come in about what makes a BQ bond a BQ bond. And I think that's one of the things considered a bank qualified municipal bond. Is that what you're referring to?
Yes, the BQ stands for bank qualified, and it gets that designation. The issuer has to apply for it when they're planning to issue the bonds. So that's how it gets the designation. It comes to market as bank qualified. So that's how we know.
Wonderful. Thank you, Kelsey. And I'm done with questions for a minute.
All right, well, let's go on to trading then. This is our next section. And Alicia, I think you are going to take this slide here.
I am. So there are a couple of different types of trading when it comes to your investment advisor picking up bonds. There is a primary market, which is primarily made up of municipal bonds. It's called the new issue market. So when we just talked about the BQ bonds, when a BQ bond or a taxable issue comes to market, there's a calendar that's released. Some bonds are competitive, some bonds are negotiated. And on that calendar, it is considered a new issue calendar. Those bonds come to market on a set day. Given the amount of oversubscription that we've seen, not a lot of those bonds make it to the secondary market. They're all purchased on the day that they actually come to market and are issued. If a new issue municipal bond does not completely sell out, then it moves to the secondary market. And it can be offered by any brokerage firm, not just the firm that underwrote the deal, and it can be purchased by anybody at that point. Also on the secondary market, we will buy agency bullets. We will buy all of the MBS and CMO bonds that we look at are on the secondary market, the majority of the corporates as well. Part of the pricing on anything purchased on the secondary market is it comes from market conditions. We're not going to see a 5-year bond 100 basis points over another 5-year bond simply because that's where somebody wants to mark it up to. So they'll all be relatively close, but the pricing is dictated by the dealers. On your average agency bullet bond, you may see 10 different offers from 10 different firms. They may only be between a basis point and 5 basis points apart, but that difference in basis points is how much money that firm is making by actually marking a bond up on the secondary market. And then also in the trading space is your broker dealer. Kelsey touched a little bit earlier on how your policy needs to include a list of safekeepers and the documents that need to go with them. There are a couple different kinds of safekeeping. You can have a custody agent who would be somebody like your corporate credit union or FHLB or even the Fed, or you can have a brokerage account. Your brokerage account safekeepers are going to be firms where you do your trading solely with them. You will buy your bond from your broker will then deliver the bond into the account and take the funds out. And then this rolls into that bottom basis or bottom bullet point there, whether it's a DVP or a direct investment. Our recommendation is that your investments go through a custody agent safekeeping account. We want all of the transactions to be completed on a delivery versus payment basis, meaning we will go out there and execute the bond through broker A. Broker A will deliver your bond to your safekeeper. there is a transaction that happens where the bond gets delivered, the funds go out. If you have a direct investment, you are calling your broker is buying the bond. They may or may not be getting competitive bids. They are then delivering that bond into your account and taking the funds out at the same time. So having a custody agent and ensuring that your bonds are being delivered versus DVP adds in that extra layer of security to make sure that your bonds are being delivered appropriately and the funds are being sent out appropriately. And then Kelsey is going to talk to us about the importance of getting multiple quotes on a trade and the amount of cost savings that we can see on just an average trade.
Yes, thank you. So like Alicia mentioned, a bond that is trading on the secondary market does have a price that's more in flux because it then becomes up to the market to decide how to sell this. The brokers and the dealers are making the decisions here. So that's why it's important for a bond on the secondary market to get multiple quotes when you're interested in making a purchase. And we have a trading example here to go through together. So this is an example of a trade we've done recently for a client. This was a mortgage-backed security purchase in the amount of $2 million. So the three prices that we got for offers on this bond are listed here in that price column. We had 103 and 16 plus, 103 and 18, and 103 and 20. And you can see off to the right, the cost difference between the cheapest price and the most expensive was up to about $2,100. So this was just one trade, but you can see the disparity between the offers that we got from various brokers. Just on this one trade, that was a cost savings for the client of about $2,100. This might not seem material or like a big deal, you know, just by itself. But if you think about this in the context of your entire investment portfolio and every trade that has happened, especially over the last 12 months, where a lot of portfolios have doubled in size, if not more, the cost savings of getting multiple quotes like this is really going to add up overall in your portfolio.
Absolutely. What is the best way to make sure that you're getting the best price on a bond, Kelsey?
It is going to really depend on what type of bond you're buying, but really having a nice broad broker dealer list is going to help because there are certain firms that get better pricing on certain types of bonds. For example, a muni bond, a certain firm just might do better on their pricing on muni bonds specifically. And as you learn that from doing more trades, you'll be able to know kind of where to go to search out the best prices. But really, the more offers, the better, because then you're really making the brokers compete with one another to get the best price and earn the trade from you.
Absolutely.
So the next section, this is the last section in the webinar, is documentation. So even with having your investment policy in place, your portfolio strategy in place, we do still need to have good, meaningful documentation on every trade that is made as well. Specifically, there are some pre-purchase due diligence requirements that regulators and examiners do like to see because they want to make sure that management is considering all the factors involved before agreeing to a purchase. So the documentation really should answer the question, why? Why did we choose the security over something else? And usually we can answer this question by going through these characteristics, including the description of the bond, whether it has any optionality or call features, if there is an extension risk, that would be in the mortgage type securities like we talked about. If there's a credit risk, what is the credit rating? The price and yield, how does that compare to other options that we could have purchased? And how is the price sensitivity looking compared to the market? So all of these things are good to include in your pre-purchase documentation and just to have on hand, because overall, we just want to make sure that we understand and have documented any risks involved in an investment.
And in all of our recommendations too, we will have a reason for why we're recommending a bond. The last thing we ever want is for you to have to sit across from an examiner, in your conference room or via Zoom video right now, and have to answer to them, why did you purchase a bond and you don't know? We want to make sure that when we recommend a bond to you and you okay it, that not only are you comfortable with the asset class, but you're comfortable with that individual bond, and you have that comparison to see that, yes, this bond is the best bond we're purchasing for the portfolio, and the reasons documented as to why as well. We're more than happy to answer those examiner questions. However, I think it's a little frowned upon, and your examiners want you guys to be able to answer those questions as to why specific bonds were purchased.
Absolutely.
And then from there, we will take it to our summary. So just a few bullet points here to wrap us up. Your investment policy should be specific enough to cover the requirements set forth by the NCUA or FDIC, but broad enough to allow for flexibility. We don't want any sort of policy language that pigeonholes us into anything. We want that policy to have some gray area, but not too much gray area. Your investment strategy is going to differ from one institution to the next. Your small $300,000 or $300 million institution is going to have a very different strategy than your $2 billion institution, not only from a balance sheet complexity standpoint, but from cash flow needs as well. So there isn't a one method fits all strategy when it comes to portfolio management and investments. Asset class diversification is key. We did a quick run through of the various asset classes that are available to us as financial institutions. Each of those asset classes offers something different, whether it be a cash flow perspective, callable optionality perspective, or a yield perspective. Having a balance of all of those things makes for a successful investment portfolio. And then making sure that detailed records are kept both pre-purchase and post-purchase. Kelsey talked a little bit about the documentation that's provided up front. We also provide the credit reviews on an annual or quarterly basis, depending on the type of bond. And making sure that you do have those items for all record keeping is important, because they will potentially get asked for in an exam on an annual or semi-annual basis.
Great summary. I would also add, just in general, everything that we've gone over today are things that we as investment advisors can and would love to help you with. So for example, if we were going through some of the policy work and you found yourself thinking, gosh, I don't know if my policy has half this stuff, reach out to us, and we'd love to help you out with anything like that. Alicia did just mention too the credit reports. McQueen does have a internal credit department to review and keep that due diligence on any issuer that has the credit risk. So that is something that has been really helpful to our clients as well.
Absolutely. And that wraps up our presentation for today. Mr. McQueen, are there any outstanding questions?
Yeah, there are a number. Thank you very much. Wonderful job. Thank you, Kelsey. Thank you, Alicia. Appreciate the information. So a question came over, what would be some of the factors to consider when deciding between Purchasing Agency MBS versus purchasing a pool of mortgage loans from another credit union or bank? Obviously with MBS there's virtually no credit risk, so the yield is lower, but what else should we be evaluating to determine which is the best to invest in?
That's a big question. I will start with it, and Charlie, if you can back me up on anything I miss. There's obviously a significant amount of due diligence that has to go into when purchasing a pool of loans from another institution. You essentially have to look at each one of those loans as though you are going to hold it, underwrite it, and keep it on your books, versus a mortgage-backed security where we're looking at the pool as a whole and we don't have any of the details on those loans. We have a lot of weighted averages, we have a lot of average detail, but we can't get the line item detail. It is not released to us via Freddie and Fannie. So yes, there's no credit risk. Well, there's still 20% credit risk unless we're buying Ginnie Mae. Let me clarify that. And yes, the yield is lower, but you may be able to gain some servicing rights on some of those mortgages, depending on how that pool is structured. Charlie, what else?
Yeah, I would say, I think to me, the biggest difference is just the numbers. When you're buying a mortgage-backed security, a big pool may have 20,000 mortgages in it. And so you're going to get the movement of the average. where if you buy
Absolutely.
10 loans, you could have a couple loans that never pay off or a couple loans that pay off pretty quickly. So you do get a little bit of prepayment risk when you're looking at a pool of loans versus the massive pool of mortgage-backed securities. The other side is credit. Obviously, we did mention that in the question there, but it is a big difference in credit because we're going with something that has U.S. government-backed, no losses versus, and I'd say that could have a loss, and a loan could be caught up quite a bit in the COVID time too, where people extending payments. So that'd be some of the differences. So thank you. Another question that came in was, how should we compare bank-owned life insurance, BOLI, versus investment securities? And I think this is an interesting question. I'll take a stab at answering it, then and throw it to the two of you to add anything. So bank-owned life insurance, otherwise BOLI, is an asset that people can invest in, banks and credit unions can invest in, and it's a way of effectually looking for a return that's outside of the standard investment portfolio. So when looking at BOLI or COLI, there's limitations that should be looked at. What's the amount that you're allowed to put in your books? Two is the cost of insurance. And a lot of times people forget to look at this and see what the actual cost of insurance is and the return. From a bank standpoint, BOLI can be very profitable because banks don't pay taxes on revenue that comes in from insurance, versus credit unions aren't paying tax anyway. So there's not as much of a benefit for a credit union to do COLI or BOLI at that point. So something to look at if you are thinking about BOLI is always look at term insurance and the cost and what that would be versus a whole life policy and the cost of insurance. Given the low interest rates in the 10-year Treasury, it's hard to a lot of times make BOLI work very well right now. But it is something that is good and can work on a lot of balance sheets.
Nothing to add. I think you answered that perfectly.
Thank you. All right, and this is the two of you. Can you elaborate on the 20% credit risk?
Yes, that comes down more so for banks than credit unions right now. Banks have a risk-weighted capital, so government-secured or government-sponsored enterprises have a 20% risk rating when it comes into rating for their risk-based capital. Excuse me, GSEs are 20%, treasuries are 0, corporates have 100% risk rating. So that's what I was meant by that 20%. We know this is coming down the line for large credit unions, but the actual schematics of it have yet to be determined.
Okay. Another question that came in is, when we're looking at new investments and making sure that it's priced well, if you're buying a new municipal bond issuance, how do you know that it is a good yield or market level yield?
Well, we in particular are seeing quite a bit of the new municipal market. So we have both previous deals to compare to that match up with that particular deal's term structure and credit rating structure, so we can try to see relative value there. But one thing in particular that we do with all of the securities we recommend, and specifically the municipals, is include what spread that we are getting over a comparable agency bond, something that doesn't have that credit risk. So as long as we're getting a nice spread to compensate for the credit risk on the muni bond, that's what we like to see ultimately.
Wonderful. Thank you, Kelsey.
You bet.
All right. That is the last of the questions that come in, and right on schedule, guys, which I really appreciate. Any parting comments before I do a couple wrap-up comments, Kelsey or Alicia?
I do not have any. No. Kelsey, do you?
Nope, I am good. Thank you.
All right. Well, thank you both very much. I appreciate the time and effort and your expertise. You do a wonderful job at portfolio management and working with everything. You two of you are wonderful to work with, so thank you very much. We do have two more, our next two upcoming webinars. We have CECL, the 2021 update, coming up on June 9th. CECL is fast approaching. Implementation is January 1 of 2023, which means everyone should be implementing CECL at the latest January 1 of 2022, so you can run parallel for a year. So now is the time to get ready and get involved in CECL, so please join us on June 9th. And then following that, on August 11th, we'll have our late summer economic update. Hard to believe I can say late summer right now, but since we are kicking off summer, but the late summer economic update will be August 11th. I would like to thank all of you for joining us today, and we look forward to seeing you at an upcoming webinar. And last but not least, another question did come in. If you'd like a copy of the slides, please reach out to your McQueen Financial Advisor or to the main number here, and we'll get you a copy of the slides. Thank you very much, and have a wonderful day.